Hello, and welcome back to ClearCast, the real estate fintech podcast. I am joined, as always, by my colleague and friend, Kenon Chen. Kenon, how are you?
Oh, good. Welcome, everyone. Please come back. Please.
And Kenon, this is, believe it or not, our 18th episode of ClearCast.
That is insane.
It's old enough to buy cigarettes.
Our podcast is old enough to, it probably is about to leave the house and ask for independence already. So
I don't blame it.
Yeah.
So we've got a great episode today. Later on, we're going to be joined by Sahil Gupta, who is one of the founders of Noah, formerly known as Patch Homes. Great conversation with Sahil. But before we do that, I want to talk a little bit about a news story. And it's actually kind of relevant somewhat to the business model that Noah has built. And that is this article in CNBC that is entitled "How to Get In on the Booming Single-Family Rental Market Without Buying a House." And it highlights a company called Fundrise, who started in 2012 as a crowdfunding platform for commercial real estate, moving now into single-family homes. So in essence, Fundrise enables small investors who might not have the funds to get a new option to kind of invest in the lucrative single-family rental market. It's kind of a new approach, new financing way for fundraising to occur. Kenon, what are the interesting things to you about this article?
Well, crowdfunding investment, it's becoming kind of a big thing, but the idea of crowdfunding, investment properties is pretty cool. In fact, the reason why there's so much interest, I guess, or demand for single family rentals. There's a quote in here saying that strong job and income growth, as well as fierce competition for sale housing, is what's fueling demand for single family rentals. And these market forces are expected to remain for much of the year, which keeps rent increases high. So I think a lot of folks are looking to cash in on the idea that rent is going to continue to be, increasing. Home appreciation is, continued to expected to continue. So yeah, how do I get in on that without taking a lot of risk? Which reminds me, maybe you had friends as well, Jeff. Pre-housing crash. Folks that kind of overextended themselves on investment properties.
Nobody did that. What are you talking about?
Maybe there might have been some, I don't know, stated income going on at that time. No one remembers any of that. But the idea of shifting that to be, something where you can invest $500 instead of, putting a second mortgage in your primary house seems like maybe a pretty cool option.
Yeah, it spreads the risk out. And crowdfunding has become obviously a pretty big deal in the world, period. So it's interesting to see it applied to real estate now. And it seems like the growth of DeFi and kind of blockchain lending is kind of leading to a lot of new crowdsourcing and funding opportunities for real estate as well. So in general, this story kind of piqued our interest, Kenon, because there's just a lot of activity and energy with different companies bringing different unique ways of lending to support real estate processes that didn't exist before.
Yeah, treating the home as if it's a part of your stock portfolio, right? And we get to talk a little bit more about that later, right? About the idea of equity investment.
Yeah. And that, again, we've got Sahil Gupta coming up later to talk to us about Noah, who has a super interesting product where they actually offer home equity financing without the burden of debt. And so essentially, you can borrow against your home's equity without any interest, and you're in a shared partnership with Noah then on your rising home equity. So again, another example of just new, unique ways that different companies are attacking, kind of drawing against equity or creating investments for rental properties. So,
Speaking
okay.
of which, would you mind giving me $500?
Yeah, I'd be happy to.
Because I don't want you to have any debt. Oh no, that's me. I don't want to have debt, but I do want to invest in this crowdfunding thing. So, how do we work that out?
Just send me a request via Venmo, and we'll make it happen.
A public request?
A public request. I have a lot of trust that if you ask me for $500, it's for good reasons. Okay. Speaking of trust, would you please entrust me with a few moments to tell a real estate joke of the pod?
I will allow it, but I do not trust what's about to happen.
It's very fair. So there's this California home buyer, right? And they find a house that they want to buy. They're really excited about it, and they need to get a mortgage. And so, of course, this means that the lender is going to require that the buyer now get a home appraisal. So the appraiser goes out to the house to perform the inspection. And the first thing the appraiser notices looking around is that right next door to the house is a school. There's something really weird happening at this school. They're having a bake sale, but the big sign announcing the bake sale says it's a pot cookie bake sale. Pot cookie.
Are you just
That's
making
weird,
fun
right?
of California? Is that what's going on right now?
Now, it is California, so this is legal. Okay, it is legal, but it's still really weird. Like, why would you be having a pot cookie bake sale, right? Even weirder still, there appears to be a gymnastics balance beam in the middle of the pot cookie bake sale with a bunch of people gathered around it, watching a grown-up guy in a suit dance on top of the gymnastics balance beam. Wow. That's crazy, right?
Based on how you started the story, I think we're still in the ballpark.
Okay, it makes a little sense. And so then the appraiser notices that the pot cookie bake sale crowd is chanting, and they're cheering on the guy while he dances on the balance beam. They're going, Principal Jones, Principal Jones. So the appraiser's like, oh, whoa, it's the principal of the school. And he's dancing on top of the balance beam at the pot cookie bake sale. Wow, this is really crazy. So the appraiser's like, this is so crazy, I'm gonna have to disclose this in my report. This is value impacting. This is a locational influence on the collateral, and it is my duty to disclose this information in the appraisal report via USPAP.
Oh,
You know about USPAP?
Would this be a positive or negative externality?
Beauty's in the eye of the beholder. I'm not sure what direction he went. So he writes up the report. He writes it all out, details everything, the pot cookie bake sale, the balance beam, the principal dancing on it, everything, writes it all up. And when the mortgage lender gets the appraisal, they reject the loan. That's sad, right? They said it's way too risky to lend on. Do you want to know what reason they cited for the rejection?
Yes, I'm super curious why.
Well, obviously it was the super high principal balance. Do you get it?
Why?
Does it make sense though?
It does with the
because the loan
cookies.
had a high principal
Right.
balance.
Principal, right.
And
it was too.
they were asking to borrow too much money.
Yes.
But also
right.
principal
but as well.
Yeah. The principal balance was very high. Okay, well, I'm glad we're on the same page.
Thank you.
You're welcome.
Well, we are excited today in our episode 18 to have Sahil Gupta from Noah. And we're excited because they're doing super cool stuff. We've actually been a fan of their business for a little while, and really wanted to give Sahil a chance to kind of talk about his background. He is the founder of Noah, which is previously called Patch Homes. They partner with homeowners to unlock the value of home ownership to live the lives they aspire to. And Noah is redefining traditional finance products by offering home equity financing without the burden of debt or additional monthly payments. We want to kind of dig into that mean. I thought whenever you got a home equity line of credit or loan, you had to pay monthly payments. So this is something different. So we'll dig into that. And Sahil, he cultivated the passion for solving financial challenges for consumers by working in product development and strategy at all kinds of great firms, Motif Investing, Sliced, Mellon Capital. And he holds a master's in computational finance from Carnegie Mellon's Tepper School of Business. Wow, that's awesome.
Yeah, it's a few heavy words out there.
Yeah, that's okay. So Jeff will have to ask questions about that. So, but we welcome you to ClearCast. Thanks for joining.
Thank you so much for having me, Jeff and Kenon. It's a pleasure.
Awesome. So, we want to hear the story, of course, about how you founded Noah, but maybe give us a quick intro first about what Noah is, how it works. How do you have home equity opportunity without paying monthly payments?
So I think taking a step back, right? I think Noah is a modern home financing company, right? That's what we do. We build creative, innovative financial solutions which are focused on consumers and their homes. And the reason we chose that is because I think homeowners on average in the US today have $255,000 of net worth. And that number is about, say, 44 times the net worth of a renter. So it really pays to be on the journey of homeownership. However, if you look at existing homeowners today, we have homeowners who are sitting on $8 trillion of home equity wealth because of rising home prices and the mortgage levels being so low. But for these homeowners, there is no easy path to accessing $8 trillion of home equity. Historically, and I'm going back 10, 20 years now, in the early 2000s, people could take out a home equity loan, a HELOC or something like that. But the reality is, since the 2008, 2009 financial crisis, most of the major banks have pulled back on the home equity business. In fact, many of them have sold those businesses and exited completely. And we don't have to look too far. Even if you look at, say, last year in COVID, I think, say, JP Morgan, Bank of America said, we don't want to make home equity loans anymore. So all of a sudden, the largest asset class, home equity for consumers, there is no way to get liquidity for that. And that is what has created a generation of US homeowners to be asset rich and cash poor. They are asset rich because they have tremendous amount of wealth in their homes. They are cash poor because they are struggling with monthly payments and cash flow. And that's the problem Noah is solving at its core. The way we're able to do that, Kenon, is we have a very powerful debt alternative solution. What we do is we enable existing homeowners to access up to $500,000 of home equity from their property without any interest rate, without any monthly payment. So it's a payment-free, interest-free form of financing. And the question, is then how does Noah make money? Well, in exchange for that financing, we share in a portion of the future home appreciation. So we are replacing what is traditionally a debt-based solution with a partnership-based, equity-based financial product, which more importantly is aligning the long-term interest of consumers who have the homes with Noah and its investors. And on the other side of our platform, we then work with institutional investors. So these are family offices, these are pensions, endowments, large asset management companies like insurances, who want exposure to single family housing, right? And we're seeing a massive wave of that already in the ecosystem. So then Noah ends up becoming a platform between consumers who are looking for liquidity in the single family space and investors who are looking to make investments and exposure to high quality single family homes all across the country.
Yeah, without having to look at single family rentals or some other investment mechanism, you're actually working with homeowners.
That's exactly right. And the value there is in the single family rental space, right? So you have large institutional companies, you have rental REITs. A lot of those businesses tend to be very operationally intensive and asset heavy businesses because the moment an investor buys a portfolio of 1,000 homes, they have 1,000 walls to paint and yards to clean and insurance and taxes, which normally means that if you're getting a 12% yield after paying expenses and other things, then your cap rate is about 5.5% really, right? With Noah, so one of the benefits institutions get is that when we partner with homeowners, the homeowners own the majority of the home and the equity in the property. They also live there because these are owner occupied. So the homeowner is responsible as always for the mortgage, the property taxes and other things. Investors are simply having a minority share of the forward appreciation, which makes Noah a very asset-light model. So we are not spending hundreds and thousands of dollars on portfolio management and home maintenance. We, in fact, are capturing that value and transferring that to homeowners and investors equally.
That's really interesting. So then if the homeowner is not making payments into Noah, sorry, this is a kind of a technical question, but I'm just fascinated by this. I want to know how it works. Then that means that during the course of them having the loan from you, that you're not receiving any cash during the course of that loan. So how does that work? How do you guys manage all that, all the inflows and outflows? It must be complex.
Absolutely. So, the one thing I'll say is that we don't call it a loan. We call it a Noah investment or a Noah contract, because even technically it's not debt. We don't show up on your credit report because this is truly an asset-focused investment rather than a credit-focused investment. In terms of how we manage our cash flow, right? So as a business, what we essentially do is we take hundreds and thousands of these home equity contracts, these Noah contracts, and we put them into an investment portfolio. And that portfolio is something that Noah manages on behalf of institutional investors. The idea is, Jeff, that over time, as you build scale, a lot of homeowners are moving every year. They are refinancing their homes. They are selling their homes, right? So that creates liquidity at the contract level. And once you aggregate enough of that, it creates a significant amount of turnover and liquidity at the portfolio level. And that is how Noah and its investors get paid. So we get paid on every transaction when the homeowner sells the home, or they decide to do a cash out refinance, or in many cases, the homeowner, they've achieved their financial outcome with Noah and said, I now have the liquidity to buy you back. And they can buy us back at any time without any prepayment penalty, without any early exit fees. So, it's an event-driven investment as far as our institutional partners are concerned, and they are happy with that relative lack of liquidity for 6 to 12 months in the initial period.
Yeah, well, that's super interesting. So tell us a little bit about your origin story. I mean, this is a pretty unique business model. It's not like you just start up a Noah franchise. It's not like starting a McDonald's. So what was the flashbulb moment for you that led you to want to start Noah? Was this important to you personally in some way?
So yes, right. I think so. As we were talking earlier, I'm an immigrant in this country. I moved here in 2006, but I was born and brought up in India. And my father, when he was constructing our family home in Delhi, which is our capital, like in 1982, he essentially did a Noah transaction on our family home. Like say we were building a single family home, which was costing us about 500,000 Indian rupees, like back then. And my father had 350,000 Indian rupees. He didn't have the last 150,000. So he turned to my uncle and said, hey, I need the money to complete this. And keeping in mind that in 1982, India didn't really have the financial markets or the mortgage market that were that well developed. So he could not access kind of, liquidity otherwise. And also say my father is a big believer, in not taking loans. In fact, he's never taken a loan in his entire life. So he turned to my uncle, said, would you give me $150,000, rupees? My uncle gave him the money, and he gave my uncle a third of the home. So from 1982, that home, our family home, has been with us. In fact, we recently just sold it last year. And over 37 years, they both were kind of your partners in the property. And most of the times we lived in the home, that there were times when we were not there, my uncle did. But that to me was the inspiration behind Noah, and said, hey, you don't always have to take on debt. And and the flashbulb moment for me was I graduated from Carnegie Mellon. So I came here in '06. I graduated from Carnegie Mellon, and my first job, was at BNY Mellon on Wall Street in 2008 February. Within the first 30 days of my career, I see Bear Stearns go down, and then within 6 months, I see Lehman Brothers go down, and I was like, why is the housing market so much more levered in this country as compared to everybody else? And I was like, there has to be a better way to do this. I think leverage and debt are phenomenal tools, but they have a place in the toolkit. What Noah is doing is creating a new type of product, which is adding to the toolkit of US consumers, homeowners, and borrowers, and saying you can use a combination of debt and equity. You don't always have to sit on one spectrum or the other. Um, and for me personally, I believe that housing is a fundamental right. Like I think, all the way from emerging markets like India and Africa to the US, I think housing is a core piece of the infrastructure of any individual's life, really. And it's important for us at Noah that we help people start their housing journey with us, and we become a partner to them throughout their life cycle.
I mean, it makes total sense, because, how many times have, family members stepped in, right, to help someone, achieve the dream of home ownership, or to, to make, I mean, that's just something that many people have experienced, especially in, it's funny in today's market with you having to be so competitive, with cash offers and things. I mean, that's happening constantly right now, so that folks can even be competitive to purchase a home. So,
and the challenge there, Kenon, is that, a lot of us are fortunate, right, who have families who have that kind of liquidity, whether it's our parents or grandparents. But I would say about 90% of America is not that fortunate, right? I mean, say 90% of US, consumers don't have a family member who has $100,000 lying around. And Noah is really for those people, right? Because again, housing should be, something everybody should aspire to, should be a part of. And we are that family friend, uncle, or grandparent who people can look to and say, hey, I've partnered with Noah. I'm sharing some of my appreciation, but I don't have to worry about cash flow. I don't have to worry about the burden of debt in the meantime. And and that's what we're aspiring to do every single day.
Yeah.
Well, I'd personally love for you to be my uncle. I think that would be very cool.
Yes, I do look a bit older than you, Jeff. So I agree with you there. I also lost my hair, so I can definitely be an uncle there.
So oh, go ahead, Kenon.
Sorry, I just thought of a stupid story, but I'll say it anyway. But I was watching Despicable Me the other night. I hadn't seen that movie for a while.
Yep.
Kids movie, and there's a point at which Gru goes to the bank to get funded for his evil scheme, and it's like the bank of evil, which is like behind the regular bank, and then in subtitle underneath Bank of Evil, it says formerly Lehman Brothers. I totally had not caught that before. Anyway, sorry, just had to share a stupid anecdote.
No, I'm surprised you said Lehman Brothers and not like a giant squid or something like that.
So sorry, Jeff, please ask your much more well-informed thought.
Well, I can't really judge you because I just said he should be my uncle, so we're kind of here. So the product has some similarities to something like a reverse mortgage in a way. How do you think it's similar or different than a reverse mortgage?
So I think again, if I look at the reverse mortgage, right, and I think that's where a lot of confusion happens. So to set the record straight, really, for consumers and listeners here, a reverse mortgage, first and foremost, is only available to people above 62 years of age in America. So that's only your baby boomer generation. Everybody else cannot get a reverse mortgage. With Noah, there is no age restriction. So our youngest client is in their mid-20s, and our oldest client is in her late 70s. So we work with the entire spectrum of homeowners. So that's first and foremost. The second thing is a reverse mortgage is still a loan. It's still debt. Noah, on the other side, as I mentioned, it's not a loan. It's not debt. It's an equity investment in the underlying home, essentially. The third big difference is with reverse mortgages. Yes, you are not making a monthly payment that's coming out of your pocket on a monthly basis, but reverse mortgages have a preset interest rate. They have a preset payment, but they have negative amortization, which means when you borrow $100 on day one from a reverse mortgage, after 1 year, that balance is $106. Assuming a 6% rate, after 2 years, it's 112. Independent of the value of the home, your balance is increasing every month, which is eating into your equity, and the consumer's hard-earned equity. With Noah, when we make $100 investment on day zero, after 1 year, it does not go to 106 automatically. It depends on the value of the home. If the value of the home has gone up, then the 100 becomes 102 or 103. If the value of the home has gone down, we also go down to 97, 98, which a reverse mortgage, the balance only goes one way, which is up. So Noah is more of an equity partnership where the payoff is dependent on the value of the home, and it does not eat into a homeowner's equity as compared to a reverse mortgage. And finally, I think if you look at the type of people a reverse mortgage is focused on, obviously it's the boomers, but the maximum amount you can get from a reverse mortgage is restricted by the government based on what Ginnie Mae does, and the maximum loan to value is about 35-40%, because they are hoping that once you die, they'll take over the house, amongst other things. Noah has a much larger criteria to helping homeowners, so we can invest up to 85 loan to value or LTV, in terms of our investment in the property. Which is almost 2x larger than what a reverse mortgage does. So it's a completely different product, one that is a mass market solution, accessible and affordable to everyone in the US housing market, as compared to focused on just the boomer generation.
Yeah, no, that actually clears it up quite a bit for me, and I think others that have tried to explain home equity investment to. You mentioned, okay, well, what if the home value goes down, right, in that time? And so that brings up a pretty interesting topic, which is right now we're in a rapidly appreciating market. I mean, we're seeing year-over-year appreciation, 16+%. I think one of the reports was 20% year-over-year, which is pretty wild. So this makes sense, for you guys. The more equity continues to increase, values go up. It seems like Noah's in a really good position. What happens if this is a bubble and that does turn? How does that affect you? But also, how does that affect your clients or your partners that have a contract with you, and what their position would look like?
Yes, so I think we look at the housing market in aggregate. and similar to Clear Capital, and I think that's one of the reasons we love partnering with you, is we're a very technology and data driven company. So what we've developed in-house is essentially a multi-stage risk model that enables us to assess the valuation, the risk profile, and the potential home appreciation of any given home and neighborhood in America in real time. So when consumers come to us, we're able to kind of leverage that data science and say, hey, we believe this home has long-term potential of 3% a year or 5% a year. And that has been a North Star for us in terms of investing, right? I recognize that the current housing market, sounds crazy at like say, 13%, 20% appreciation. We actually don't, we and our investors don't underwrite to those levels. It's nice to be there, but I think long-term average US housing market is about 3.8%, and that's what we generally are underwriting to. The other thing that I think Noah does as a company so much better than I think many others is we don't take any balance sheet risk. So at the start of the conversation, I mentioned we have an investment business as well, where we partner with like family offices, asset managers, pension funds. So we're essentially a money manager for those institutions. So we raise that capital, we invest on their behalf, we manage on their behalf. So even like, so what we're essentially then doing is we are transferring home appreciation from a homeowner to the investor and vice versa. We're managing it, but we're not putting our own balance sheet at risk. And that enables us to weather a flat or a down market much better than some of the more balance sheet heavy companies you've seen historically. The other thing we've done, again, kind of looking at data science, we've run multiple historical backtesting model simulations really. It said if you go back 30, 40 years in the US across the ecosystem, and what we realized is, Kenon, even if you go back to the 1980s, early 1990s, over the past 35 to 40 years, in about almost 90% of the cases, home appreciation has been positive on a 10-year rolling, on a 10-year rolling contract, model. And that's what Noah does, right? So in 90% of the cases, we believe that the homes will go up over time. You have to be patient. Long-term patience is important. And that is how it enables Noah to kind of say weather the storm. And, if anything, as a consumer-focused company, I think it's really important for businesses like ours to stay open when the markets fall.
Yeah.
And a classic example of that, so two examples come to mind. I think so one is in 2019, 2020, when COVID happened. I think a lot of home equity companies, including the big banks, pulled back and said, we don't know where valuations are. We're going to pause. We're going to wait for 3 months. We at Noah didn't do that because we believe our doors have to be open 24/7 if consumers are looking for liquidity. So, I'm proud to say we were one of the only companies in the home equity space that was actively investing, even through March, April, and May of last year. So I think that's one thing. And I think with that risk also comes reward and opportunity. And for that, I'll go back to 2009, 2010. I think say Blackstone took a massive bet with Invitation Homes and buying, I think thousands and thousands of homes. And today, it's Invitation Homes is a $20 billion company and one of the largest single family investors in the country. So I think we take our inspiration from events like this and say, we want to be open for business. We want to be able to price risk effectively, and we want to partner for the long term.
So speaking of downside risk and things that happened a lot in 2008 and 2009, unfortunately, defaults and foreclosures are back in the news. Obviously a lot of folks were negatively impacted by the pandemic initially, record levels of forbearances. There's a potential increase in with moratoriums expiring and defaults and foreclosures in the months and years ahead. Does that impact Noah? And if so, how?
So I think first and foremost, we come back to the partnership angle, right? Noah's core business idea is we provide homeowners with liquidity, with no monthly payments, no cash drag essentially on an ongoing basis, and we share long-term risk with them. If I look at what's happening in the market today with forbearances, right? I think last year the forbearance rate for the GSEs was about 8 to 9%. within the Noah portfolio, it was a fraction of that. Why? Because when we partner with consumers, we are not burdening them with more debt. We are not burdening them with a $3,000 monthly payment. So the lack of a payment actually improves the financial profile of the average Noah customer as compared to somebody who's taking out a home equity loan or a HELOC, firstly. The second thing, we've looked at data. More than 50% of our clients, Jeff, when they work with Noah, they are using the money to pay down high interest debt. So whether it's hard money lenders, student loans, personal loans, credit cards, which is helping them improve their financial profile, improve their FICO scores. So they are in better standing to kind of essentially withstand a COVID-like event as compared to something like, as compared to, somebody who goes and takes on a third mortgage. And that's the reason we saw that even historically, the default rate in the Noah portfolio is again a fraction of what you generally see in the second lien market or the mortgage market. And I think to the extent that there will be instances where customers will find themselves in default or foreclosure, right? Life happens. We understand that, and as part of that, we actually launched a program called Homeowner Protection Program. So the Noah Homeowner Protection Program is exclusively available to Noah clients who, after we make an investment in the home, if they run into financial hardship, they have the ability to access additional cash from Noah without interest, without monthly payments, and that goes on as a one-time payment to either pay their mortgage or repair a leaky roof or to kind of pay property taxes because you lost your job. And the homeowner protection program is something we've seen has a very strong affinity with our clients because it's almost helping them in times when there is no other door open for them. So we follow these kind of different things, right? We help you up front. We have a safety net of a homeowner protection program, but it's really about long-term alignment with our clients.
I like that, and I like the I guess it's, if you will, the freedom you're giving someone by having a solution more tied to the asset itself, the collateral itself, as opposed to where they're at in their journey. Yeah.
I actually will give you a story on that, right? So one of our clients, she left her job and she wanted to start a small business in Colorado, and she wanted to make these organic protein bars, and she had more than $100,000 of equity, like in her home. And she reached out to us and said, "Hey, I want to pull some equity out because I'm starting a small business." And she didn't take a small business loan because a small business loan still requires you to make a monthly payment on it. They also put a lien on the house, but they require a monthly payment. And I think we all are kind of executives, entrepreneurs, founders here. We recognize that it's so important to not have that payment on your loan initially.
Yeah.
So she came to Noah. She took out, a chunk of her home equity, but more importantly for her, she was able to start her dream small business, which is enabling her to drive a successful financial outcome without the worry of monthly payments. And I think that's really the focus here is historically, I look at the housing market. A home is the most important, the largest, and often the most expensive purchase and asset that most consumers have. However, we always treat the home as a liability. It shows up on your credit report. It shows up on everything else. A home is not supposed to be a liability. It's supposed to be an asset. And I think that's what is different about Noah. We treat it like an asset. It's the first time when the homeowner is not paying for the home. The home is paying for the homeowner.
That's great.
Yeah.
So what's next? I mean, it sounds like you've got a lot of great work to do now. Is there something big on the horizon as you see kind of, especially coming out of COVID here and into the next year that you want people to know about?
Absolutely. So I think we have two big things that I'm really excited about, right? One is a very technology and data-driven company I mentioned earlier as well. We've increasingly invested on the investment side of the platform, right? So our consumer technology is amazing. People can get qualified in 60 seconds. They can get funded in 15 days. And we continue to iterate there. But what we've also done now in the past 6 months is we've built out a life cycle investment platform where an investor who comes to the Noah platform on boards, with us, they can see the entire journey of their investment from origination to exit, and it's completely automated for them. So I'm excited about the work we are doing on the investor side of the business and kind of launching a new portfolio tools for them towards the end of this year, early next year.
Mhm.
The other thing on the consumer side, which I'm excited to share, is we really think that I think housing affordability, and you mentioned this at the start, I think affordability has become a big challenge. And in fact, I think the millennials and professional Henrys, as we call them, they represent the largest, like say, buying segment of the population after the boomers. However, like 66% of millennials need some form of down payment help, either from a company or from their uncle, or family members. No one wants to be that uncle and family member. So we actually are we are we are going to be launching a down payment assistance program, which is targeted to help people buy homes in a way that with Noah's help, people can get to a combined of 20% down payment. It will enable them to qualify for conventional financing at 80 LTV, enable them to lower their monthly payments by 30% and avoid PMI. And it will really allow them to use their cash cushion to move into the home and to do whatever home expenses they have and save it for a rainy day. So that our down payment assistance program is something we've been working on, and we are hoping to launch that in Q4 of this year. So I'm really excited about that.
That is really exciting and very timely, as you mentioned. I think prices are just astronomically high right now, and it doesn't seem like they're coming down soon. So,
Yep.
really, really good timing.
Absolutely. And and the reality, Jeff, is that even for those who have 20% down, the moment a home sells for 10% over asking, you no longer have 20% down. So you either have to go and get a bigger mortgage, or you have to say give up your dream of home ownership. And for us, that 2-3% should not really stand between the start of the housing journey and creation of wealth through home equity. We want to bridge that gap for every single American in the country.
That's awesome.
Yep.
Well, this was a great story, your personal story as well as Noah's story of where you've been and where you're going. Very unique business model. And we definitely want to thank you for joining us today, Sahil.
No, thank you so much for having me. I really enjoyed the conversation.
Yeah, appreciate it. And we'll be looking out for what you're doing next.
Absolutely. I'll talk with you soon, guys. Thank you.